In this video, I'll tell you all about the crazy world of penny stocks and if they're a path to riches or ruin. And we're starting right now. Hey everyone, Elliot here. So chances are you've probably heard of penny stocks. If not, they're nothing more than very low price shares of companies. How low? Well, the classic definition is $1 per share, hence the name penny stocks. But the more modern SEC definition includes any stock that is priced under $5 per share. So is there anything wrong with them? On the surface, no, not really, and penny stocks are perfectly legal and legitimate shares of stock issuing corporations. But, and this is a big one, penny stocks are also not like most other stocks. For one thing, they're very volatile. The small share price pretty much ensures that price swings are the norm, and speaking of price, there usually isn't much agreement on it in the marketplace, with sellers asking one price and buyers bidding on another. Trading volume on penny stocks is often very low, and all this adds up to shares that are easy to buy, but can be notoriously difficult to get rid of. And that's not all. Another major issue with penny stocks is the fact that their price can easily be manipulated by outside forces that have nothing to do with the performance of the underlying company. Rumors, exaggerations, and outright lies can easily pump up the share price of certain penny stocks and get investors excited, only to crash back down when the truth is revealed. While in theory this can happen to any stock, in practice it's much harder or damn near impossible to quickly pump and dump the stock of a multi-trillion-dollar company like Apple or Microsoft. But it's much easier when the market cap is just $1 million and the shares are $1 a piece. That isn't to say penny stocks can't rise in value for legitimate reasons, such as real and tangible success of a small company, and sizable gains can be had if you bet on the right horse. On the flip side, you can easily lose just as much, and perhaps there's this rather gambling-like reputation of penny stocks that attracts some investors. So what kind of companies issue or end up with penny stocks? And what are you really investing in? Well, there are two possibilities. The first and the most typical possibility is that a penny stock represents a growing company with limited cash and resources. It's likely very small, sometimes with just a handful of employees, and the stock price reflects this tiny stature. Another possibility is that the company is bigger, but it's failing, and the stock price, which was once much higher, is now penny stock territory. Let's take a closer look at the first variation and ask, why would a tiny but growing company issue cheap stock? Well, here's the thing. When you incorporate as an S or C Corp, you're automatically allowed a certain number of shares, which you can sell if you wish. Now, most small businesses do not incorporate into S or C Corp and remain as an LLC or limited liability corporation. If they do incorporate, the CEO, whether literally or figuratively, just keeps the shares locked away in a drawer and they never see the light of day. In both of these examples, the company effectively remains privately held and funding comes from seed or venture capital or from actual operations. In a perfect world, what you really want to do is to remain private while growing the business, and when ready, go public with an IPO. Your profits will then support a high share price, which will be helped by the increased awareness of your company in the marketplace that comes from doing an IPO in the first place. But that's not what some companies do. Instead, they sell a large number of shares to raise money, but since the company is small and often not yet profitable, the share price is in the toilets, so to speak, and worth just pennies. They really shouldn't be doing this, but it's a quick and easy way to raise much needed capital. Now, the second variation of a penny stock that I mentioned earlier is the company failing. Their shares were once worth maybe $20 or $30 each, but either through mismanagement or a decline in business outside of their control, the company's revenues have dried up, and as a result their stock price plummets, and voila, it is now a penny stock. Along the way, the company may also get delisted from whatever stock exchange it may be on, as all the big ones like NASDAQ and the Dow Jones do not allow penny stock listings. This is of course a major problem for a company, and most will do whatever it takes to not get delisted and get thrown off an exchange, including doing reverse stock splits to artificially prop up their share price. This of course brings up an interesting question. Where do you find penny stocks? Turns out all of them are bought and sold on what is called OTC, which stands for over-the-counter. OTC is the process of trading securities using a computerized broker-dealer network as opposed to a centralized location like the New York Stock Exchange. Stocks traded over the counter are referred to as unlisted, and that is where you'll find all the penny stocks. Now, it's not just penny stocks you'll find on OTC. Bonds, derivatives, and other instruments are also traded there, and in general it's a bit of a financial Wild West with looser reporting and regulations and just overall riskier investments. Now, how do you enter this world and maybe dip your toes into penny stocks? Well, that part is actually pretty easy, as just about every online discount broker gives you access to the OTC markets, so buying shares is as easy as typing in the company's ticker symbol and hitting the buy button. The big big question is, should you? Well, here's where things get interesting. Penny stocks as a class of investments are very tempting for a lot of investors, and it's not hard to understand why. In fact, household names like Tesla, Netflix, Nvidia, Nike, Amazon, Apple, Microsoft, and Disney all started their life as penny stocks, with some like Ford and GM sinking and bouncing back. The attraction here is very simple. If you can catch a company when its shares are penny stock cheap, you'll load up on a large number of them, and if the stock shoots up dramatically, you will profit big time. That part is easy to understand. What is of course much harder to guess is which companies will shoot to the moon, and that is literally the million-dollar question. You could of course put your money into dozens of companies. After all, the shares are very affordable and the barrier to entry is practically non-existent. However, with over 90% of penny stocks failing, your odds of success are abysmally low. In fact, a study of OTC stocks from 2001 to 2010 concluded that the average annual return for them was negative 27%, and on average an individual investor loses several $100s per year on penny stocks, for a collective total of $18 billion in losses annually. Not exactly the winner's circle, but yet every once in a while some investors do hit it big, and it's those stories that feed the narrative that you can strike it rich in the world of penny stocks. This all of course begs the question, is there a way to reliably pick future winners? Well, reliably no, but there are ways you can stack the deck slightly in your favor with a number of penny stock picking strategies. I'll go over a few of them right now, but be forewarned, there are no guarantees and you may still lose money. So the first suggestion is to pick stocks from the top tier of the over-the-counter market. The OTC is split into three tiers, with OTCQX on top, OTCQB in the middle, and OTC Pink, also known as just pink sheets, at the bottom. Made famous by the film Wolf of Wall Street, pink sheet listings don't have to file with the SEC and are therefore completely unregulated, very speculative, and very much prone to pump and dump schemes. However, the top QX tier has much stricter financial standards, with the QB tier, also referred to as the venture market, somewhere in the middle. The top OTCQX tier actually has a lot of strong companies listed, including many foreign ones, and most could qualify for the larger exchanges but choose to go over the counter to save money. This tier will act like a filter for you, thus eliminating shady companies or shell corporations, but the downside of course is that only about 5% of penny stocks qualify to be listed with the OTCX, and you will miss out on the vast majority of them as they're hanging out either in the middle tier OTCQB or more likely lurking among the pink sheets. The second suggestion, and this applies to whatever tier of the OTC market you go with, is to do fundamental analysis, and while you're at it, automate the process. Now keep in mind, you may not have access to it as much fundamental info in the penny stock world as you do with companies on the major exchanges, so you may have to dig a bit deeper. If you're taking a close look at a company and cannot find any meaningful info on it either on the broker's website or on the company's site, you should probably bypass this one completely. It's in the company's interest to declare this information, and if they don't, something definitely isn't right. So what do you look for, assuming you can find the information? The fundamentals to take account of include liquidity, leverage, performance, and valuation ratios. Here are a few to get you started. For liquidity, look up the current, quick, and cash ratios, as well as the operating cash flow. For leverage, check the debt ratio and the interest coverage ratio. For performance, look up the gross and operating profit margins, return on assets, and return on equity. Finally, you have valuation, and here look for the price to earnings, price to sales, and price to cash flow ratios. I'll make a separate video on fundamental analysis in the future, but for now you could easily look up the formulas for all the items I mentioned. They are very simple to use, with the biggest challenge being finding the actual company financial data. As I mentioned earlier, not all penny stock companies will be forthcoming with this, as they aren't required to disclose anything to the SEC. Now, can you use automation to help you research and pick penny stocks? You sure can, and with over 10,000 stocks listed on the OTC markets, it's a very good idea to actually do so. This brings me to suggestion number 3, and that is to use a stock screener. A screener is nothing more than software that is programmed to filter out stocks based on settings that you input. You can then focus on the stocks worth looking at closer, thereby reducing the background noise and making your job much easier. Screeners can be included in stock trading platforms or can be standalone web-based, just depends on the vendor. Here are 5 popular ones: Stocks to Trade, Benzinga Pro, MarketWatch Stock Screener, Yahoo Stock Screener, and TD Ameritrade. As always, always, no endorsement is implied, I'm just letting you know what is out there. Screeners vary in their ability to set screening parameters, which can depend on if you're using a free or paid version, but they can all let you see the stock's 52-week highs and lows, its PE ratio, volume, price, percent change, and usually much more. You will still have to do your own follow-on research, but at least you're working with a much smaller group of worthy candidates and not sifting through thousands of duds. So, what to do if you find a few stocks that you think may be solid companies with a bright future? Well, give it a shot and buy a block of shares. Be sure, of course, that this is disposable income you're using and limit your risky investments like penny stocks to 10% or less of your portfolio. Monitor your investments carefully and be ready to sell, and also be prepared that the stock will stay the same or go down despite your best research. But then again, you never know, and that is the allure of penny stocks, the chance that you may be right and the stock goes through the roof on some great company news. Proceed carefully, things can go either way. Okay, I hope you enjoyed this introduction to the wacky world of penny stocks and got a lot out of this video. Please do subscribe, and I will see you next week.